Hello, in this lecture we will continue on Chapter 6, talking about inventory costing. We're going to talk about the cost flow methods. So inventory costing is going to be the idea, of course, of us buying the inventory, tracking the cost of that inventory, and then selling the inventory and trying to know what the cost of that inventory is that we sold. This would seem like it might be an easy thing to do, but as we know, even if we buy the same things, the costs change over time. So if we bought large types of things and resold them, such as cars or things that are very customized in nature, such as we have like customized surfboards or something like that, we would know exactly what that individual thing costs. And when we sold it, we would have a tag or a number that would indicate the cost of that individual item. However, if we have things that are very similar in nature, we buy things that are very similar and then we resell them, then the having a specific identification is not as cost effective. It doesn't make sense for us to track the specific identification of something that is very similar. So things that are generally lower cost and more homogeneous or the same in nature, we will use a cost flow assumption for the most part. We're going to assume the flow of the products and in this fashion. Now you might think that if we bought all the same stuff, well then the price should all be the same all the time. But once again, it's not, because things change over time, even if we're buying very same product and a very similar product every time. And usually that change means that it's going to go up over time because of inflation. Just the inflation of money will generally go up. Even the target inflation that the Fed generally shoots for is around 3%. So we know that the valuation of money could cause the cost of things to rise over time, all else equal. Also, things could go down for many other things. I mean, things could go up or down for many other reasons. It's just changes in the market, changes in the types of inputs that could be into certain types of products could change the cost flow in any direction. Point being, the cost of what we buy, even if they're homogeneous items, the same types of items, will change over time. And then when we sell the items, we need to know which items we're going to sell. It's not effective for us to track the specific cost on smaller items. Therefore, we're going to use these types of assumptions. So we're going to assume one of the most common types of assumptions is the assumption that we're going to sell the first one that we bought and keep the last ones. So that would be similar to how you might think of if you stock shelves. If you've ever stocked shelves on a supermarket or something like that, of course, you would put the new items in the back, hopefully, and try to sell the older items generally. That doesn't mean that that's going to be the way that all the products actually move. That's just an assumption we are making. Last in, first out, remember, is going to be the idea that we're going to sell the last items. So that would be like you're stocking the shelves and you put the new milk in the front all the time and you always sell the new milk and you never sell the old milk. Obviously that wouldn't work with milk, but I mean, if you had things that lasted over time, that would be the assumption. Notice that no company really tries to do that, really. You're going to try to sell the older product most of the time, even if it's a product that maintains its value over time. Usually that would be the case. But the last in, first out assumption is useful for a couple reasons. One, it might be used in practice to try to lower taxes, and we'll talk about that later. But it's also a really good contrast to the first in, first out, these two types of assumptions, and it's a good example of the way assumptions can really affect the bottom line in terms of net income and whatnot. The average is going to be the average cost. So this would be the in-between between these two methods in terms of the effect on net income and ending inventory. And that would be the assumption that every time we sell something, we'll just take the new average of whatever the costs were. So let's take an example of some of these. This is going to be our general cost flow that we'll take a look at. All these three examples, and we'll take a look at the same numbers in the cost flow examples. And you'll see the differences even with the same numbers of these different cost flow assumptions. So here's the grid here. Now, when we think about the cost flow assumptions, it could be fairly easy for us to kind of think of it through our mind, the flow of the inventory. But the problem with real life ends up happening is that we think about the flow of the units, and then we also have to think about the cost of those units. So when we start to actually map this out, it does take a bit of time for us to formally put it out in some kind of structured process, because it does get a little complex once we start putting in the dollars and the units. So, for example, we have the units here. We bought 10 units. We don't know what they are, 10 units of inventory. and we bought them for $91. Therefore, the cost is $910. The 91 times 10, the units we have are 10 units on hand. Then if we bought another 15 units at 106, then we multiply that out, we get 1,590. Now, if we notice what happened is the price went up for the units we bought. Now, we're not sure if they're the same types of units or different units, but even if they were the same types of units, that would be the normal kind of trend, all else equal, just in terms of prices generally go up. They might not go up that drastically, but prices will generally grow up over time, and that will generally be the assumption. If that happens, then certain assumptions can be made between the cost flow assumptions. But in any case, now we have the 10 plus the 15 or the 25 units over here. Then if we have a sale of 20 units times the 130, that's at the retail price. There's another thing that's confusing about cost flow. When we sell the units, we're obviously going to sell them for whatever we sell them for, but we're also going to sell them, we also have to think about how much they cost, meaning these 20 units cost either 91 or 106, depending on our cost flow assumption. And we know that the units are now down from 25 minus 20 to 5. The question is, how much do those units cost? They don't cost 130, that's what we sold them for. They cost either 91 or 106, depending on our cost flow. And then if we keep going through this, we got a purchase of another 20. Once again, the price went up to 115 from 106 to 115. That's 2,300. So now we have 20, the 5 plus the 20, or 25 units now. Again, we don't know what the cost is. That's what we're going to look at in the future. Then we have another purchase of 10 units at 119. Once again, the cost went up. Multiply that out, 1,190. Now we have the 25 plus the 10, or 35 units. And then we have a sale of 23 units. We sold them for 150. Notice our price went up, but that just represents what we sold it for. So we have the 35 minus the 23 gives us the 12. We don't know what they cost us. That's what we'll have to take a look at. First way we can think about it is the specific identification method. So if we know exactly what the units are that we sold, like cars or something with large units that are different, not the same, non-homogeneous, then we can use the specific identification method. So if we bought 10 units at 91, then on our balance sheet, we would have an ending balance of 910. Then if we bought another 15 at 106, we'd have another 1,590. Therefore, we have two layers now on our balance sheet. We have 10 units at 91, 15 units at 106. That's a total of 2,500 on our balance sheet. So on our trial balance, we would have 2,500 in assets as inventory, and this would be backing up that number. Then it says right here, for 20 units sold on August 14, the company specifically identified that 8 of those units were the 91 and 12 were the 106. So now we made a sale. And what they're saying is that 8 of the units, that's not what we sold them for, the 91. That's what we bought them for. We sold them for some number above that. And remember up here, we sold them for 130 each, apparently. But they cost 91 for 8 of them, and 12 of them cost 106. Therefore, the cost of goods sold, the expense that's going to reduce net income, will be 2,000. So we sold them for 130 times the total that we sold, and we're going to record revenue on that. Then we got an expense of 2,000 on the income statement. If we look at our ending inventory, then we have the 10 units at 91 minus 8 brings us down to 2 times 91. We had the 15 units at 106 minus the 12 brings us down to 3 at 106, giving us a total ending inventory on the balance sheet of 500. Then on August 17th, we bought 20 units at 115. Now we're just bringing down these two layers. Those are still there. And now we have another 20 units at 115 for a total on the balance sheet at the end of 2,800. Then we bought another 10 units at 119. So now we just brought down these units again here. We have 2 at 91, 3 at 106, 20 at 115. Now we have another 10 here. And if we multiply all those out and add them up, now we have 3,990 on the balance sheet. And then it says we sold on the 23rd, 23 units on August 31st. The company specifically identified each bike sold and its acquisition cost. So they didn't tell us exactly what the acquisition, but this is the acquisition that they tied them out to. So we sold 2 units of the 91. We sold 3 units of the 106. We sold 15 of the 115 and 3 of the 119. How did we know that? Because we specifically identified those units. Therefore, the cost of goods that we sold are here. Remember, that's not the sales price. The sales price is 150 times the 23 units. The cost is the 2,580. So the net income is affected by the sales price, this times this, minus the cost of goods sold, the expense. What's left in ending inventory? Well, the 2 units, totally wiped out, aren't there anymore. The 3 units, totally wiped out, aren't there anymore. The 20 minus the 15 gives us 5 at the 115. And the 10 minus the 3 gives us 7 at 119. We're left with a dollar amount of 1,408 on the balance sheet. So now we could think of the first in, first out method. In this case, this is a very common method for things that are the same in units. If they're not cars, if there's stuff like we're selling nuts and bolts or something, they're all the same. It doesn't make any sense for us to specifically identify those units. We need to just make an assumption. The assumption here being that the first units we bought are the first units that we sold. We're not going to care about tying out the social security number or the ID number of the units in this case. We are just going to assume that the first units are the first ones sold. That will be easier, that will be cheaper for us to track, less costly for us to do so. So same numbers, and we'll just see what it works out to in this format. So if we have the 10 units at 91, then once again we start off with the 910. Then if we buy another 15 at 106, now we have these same units here, plus the 15 at 106. We have an ending inventory on the balance sheet of 2,500. Then on August 14th, we sold 20 units. If we sold 20 units, we're going to assume the cost is first from the oldest units, these 91s. We sold all 10 of them. We wiped them out. And so that would be this sales price. Then we sold whatever we needed to get up to 20. 10 plus what gets to 20? Another 10 of these 15 at 106. So here's our 20 units that we sold. And if we multiply that out, the cost of the goods sold then is 1,970. And how much do we have left? Well, the 10 units got wiped out, the old layer got wiped out, and the new layer is down to 5 units, 15 minus the 10. So we have 5 units at the 106, or an ending inventory of 530. Then we assume we bought another 20 at 115. Once again, the price is going up for our purchases. So we have 2,300. We still have this old layer here, the 5 at 106. Now we have the new layer, 20 at 115. Our ending inventory at this point is 2,830. Then we bought more. We bought another 10 units at 119. Once again, the price is going up. Therefore, we have another layer. So our oldest layer now is 5 at 106, which was from here, and then the 20 at 115. And now we have the new layer, 10 at 119. If we multiply those out, add them up, ending inventory of 4,020 on the balance sheet, on the trial balance. Then we're saying we made a sale of 23 units. If we made a sale of 23 units, the question is, which of these units did we sell? Well, under first in, first out, we sold the oldest units. We sold these 5. We sold 23, so we're going to wipe out the 5. The 5 at 106. Then we sold 18 of the 20 to get to 23. So we only sold 18 of these 20 at 115. So if we multiply that out, we have a cost of goods sold of 2,006. Not the sales price. The sales price, remember, if we look way up here, was going to be 150 times the 23. So that's how much we sold them for. The cost of the sale is going to be 2,600. So the revenue minus the cost is our effect on net income. How much do we have left? Well, this 5 got wiped out. The 20 minus the 18 gives us 2 at 115, and we haven't touched this 10 at the 119 yet. That layer is still there. Therefore, we have an ending inventory of 1,420 under first in, first out. We'll continue on to average and LIFO next time.